Now I would like to introduce our panelists for this econ development panel. We have Dr. Itay Goldstein again as the panel chair. Following him is Dani D'Amico, partner at McKinsey, New York. With 25 years of consulting experience in the intersection of risk, banking, and technology, Dani's experience in operating model assessment and development, analytics, regulatory response, and compliance is unparalleled. Her perspective will be valuable in understanding the intricate dynamics of global finance. We are also honored to have Ebrahim Poonawala, Managing Director and Head of North American Bank Research at Bank of America Securities. Ebrahim is a distinguished figure in the financial sector, known for his expertise in fintech, blockchain, and crypto assets. His analytical prowess and extensive background in risk management will offer unique insights into stability of financial systems. And last but not least, we welcome Werner Rehm, partner at McKinsey, New Jersey. As corporate finance expert and one of the leader of SNCF Insights and leader of firm investor relations and investor communications, his expertise positions him to uniquely provide insights on firm and financial institution performance disclosure and its effect on firm stability and communicating corporate strategy and managing investor relations during turbulent times. Ladies and gentlemen, please join me in welcoming our esteemed panelists as we embark on a journey of discovery and dialogue on global economic development.
Okay, thank you. So the way that we will organize the panel is going to be as follows. I'm going to ask each one of the panelists one question to dig deeper into based on their experience and their reflection on recent events. So each one will take a few minutes to answer the question, and then after that we will open it up to a broader discussion. So I will start with Dani here next to me, and the question I would like to ask you is, you have a lot of experience with financial institutions, about 25 years of experience. You have seen banks in good times and in bad times. The question is, to what extent were you surprised by what happened in 2023? What do you think we learned from this on risk management practices? What will be some of the implications for regulation of the banking system and for the practice of banking going forward?
Okay, thank you. Is it working? Great. So let me start by kind of saying it's not that cool to be a bank anymore. It's lost a lot of its shine, and banks are not making great returns. It's not a great asset class to be in. And I think this is there's some big secular trend that I'd like to speak to. And so what happened in 2023 kind of really points to some of the elements of why it's not that great to be a bank. So you mentioned 1934, FDIC started the insurance, and people were lining up outside of banks in the Great Depression to get their money out. Fast forward 2008, people were lining up outside of banks. So not much has happened between 1934 and 2008. And WAMU, who's still the largest ever failure, was a $300 billion bank, and people were lining up outside of WAMU in 2008. Fast forward to last year, and nobody was lining up anywhere, and Silicon Valley and then First Republic lost tens of billions of dollars in a very short period of time, and nobody was lining up. So we have 90-year-old regulation that was catering okay, in an okay way up until 10, 15 years ago, and then something happened and it wasn't fit for purpose. So that's kind of like trend number one, is you talked about technology, we'll speak about more, is things have changed, and has regulation kept up? So that, I'm gonna get back to that. Two is, I said as an asset class is not that interesting anymore, is if I think of, for example, valuation of asset classes, on average, tech stocks are 9 point something price to book, they're valued. And if you take all, and this is like the top, the sexiest asset class is technology. At the bottom of the pile, 0.8 price to book value, 0.8 for banks. So the capital market is valuing banks. You're gonna probably call me out because you're the analyst here. But it's less than price to book. The market is valuing the banks at less than 1. And so that's kind of like why. And then the third thing is assets are moving outside of the banking systems. What do banks do? They take deposits, they issue loans, and they provide the infrastructure to kind of make money move around, the payment rails, and wealth management, other things, whatever. But fundamentally, they take money, they lend money, and they provide the infrastructure. A big secular trend happening is the balances are moving off balance sheet. So if you guys have heard of financial sponsors, so we all talk about JP Morgan, we all talk about like the big banks, Goldman Sachs, etc. Financial sponsors are taking a larger and larger share of assets. And so KKR, Thoma Bravo, Apollo, Ares, Blackstone, these are some of the names that are soaking up a lot of the balance sheet. And there is a consistent migration of balance sheet outside of the banking system, to the point that the growth rate of off-balance sheet is significantly higher than on-balance sheet growth in the banks. So fintechs are kind of like butting up against their banks on technology. Financial technology, the fintechs, the ones you hear most are the likes of Plaid, Square, all payment, Venmo, PayPal, all payment technology. So technology are like encroaching in banks. The private equity funds are encroaching on banks. And deposits, the deposit franchise is not really worth anything because we saw that Silicon Valley and First Republic have lost all their value in their deposits. There's no value in a deposit franchise. And that's why the banks are worth a ninth of what technology companies are worth. And so in amidst of this is regulations. And the regulation is, how do regulators keep up with those things? Yes, they can do the tag program, the transaction account, the temporary lift on the deposit cap that they did when Silicon Valley happened. It's called the tag program. They were able to do the tag program because they called the systemic risk exception. On the weekend that Silicon Valley went down and the FDIC took them over, they called it the SRE, and that was by Congress. That's how they could invoke the lift on deposits insurance. Now, was Silicon Valley a systemic risk? Was it big enough to be systemic risk? I guess for them it was in order to do that, but the whole regulation is set to say that Silicon Valley is not a systemically important bank. The whole regulation, and it was overhauled in 2019 through the tailoring rule. The tailoring rule enacted the Economic Growth, Regulatory Relief and Consumer Protection Act, split up the banks into 4 categories, and Silicon Valley was somewhere between below Category 4 and Category 4 bank. Lightly regulated bank. And on its way to be somewhat regulated bank, a Category 4. Category 1s are the G-SIBs, JP Morgan, Goldman Sachs, Citibank of America. Heavily regulated. Category 4, less so regulated. But still, they build all of the regulatory machinery around what's systemically important and not systemically important. One would say, then this is a crisis moment for the regulators of what do we do? What is systemically important and how do we regulate those banks when the assets are moving off balance sheet? Do we regulate the fintech companies that are providing the payment rails? Do we regulate the financial sponsors where all the assets are? The playing field is completely different, and the regulatory system is not really kept up with how these are. There's a lot of reckoning that needs to happen in order to right size who do we regulate and how, versus what the banks do versus the ecosystem of financial providers. I probably spoke a lot, so I'm going to stop now.
Okay, thank you very much. That was very interesting, and we'll come back to some of these issues later. I will move over now to you, Ebrahim. So one of the things, I talked about it a little bit in the opening remarks. One of the things that I think caught everyone's attention is the connection to crypto. So crypto is obviously a new thing, and I think a lot of people are skeptical about it. Initially, the idea was that this is going to prevent some of the fragilities we had in the past, but now it might bring them back. And when you look at some of the failures that we had in 2023, going back to Silvergate and Signature Bank, they were connected to some extent to crypto assets. So this is something you have been following, and the question is, what do you think was the role of crypto in all this? Is this something we should worry about going forward?
Thank you. So first of all, thank you for World Salon and Charlie for inviting me and having me here, and thanks for a great keynote, Professor Goldstein. I think if I can just take a step back, it's worth, the discussion we've had this morning, it's worth reminding the uniqueness of the banks that failed in March, right? And we can talk about just the competitive advantages that banks have lost, how much they're regulated today versus 10 years ago. I think what each of you should go back and sort of, when you're looking into, is look at the uniqueness of SVB and Signature Bank and Silvergate that failed during that. And remember that 99.9% of the US banking industry managed through and navigated that, right? Without depending on the Fed, especially when you look at some of the largest 50 banks in the United States, they navigated through a period which was extremely volatile. So I think it's worth keeping in perspective, and why were they unique, right? I think Dani mentioned about the deposit insurance up to $250,000. Banks like Signature, Silvergate, SVB had 90% of their deposit customers who were uninsured. So when the panic ensued, you had a concentrated group of customers who banked with these companies because of their specific business models, who decided to take out anything that was uninsured and ran. Silicon SVB lost 40% of their deposits in one single day because they banked a lot of startup companies which were VC funded. You had very prominent VCs talk about it's probably advisable to remove deposit from SVB, and that was a trigger event that led to the liquidity run. Our group covers 40 banks across Canada and the US. I would say every bank that survived had managed through that because they're not like the 3 or 4 banks that failed. Because what do? A bank in the Midwest caters to middle market businesses that Thoma Bravo or Blackstone may still not be able to reach, provide financing, take their deposits, provide working capital, treasury management, whatever the small businesses in Dallas or in Columbus, Ohio need. And they managed through that, right? So it was a tough period, but I think it's worth sort of keeping that in perspective in terms of the uniqueness of these banks relative to what happened with the rest of the industry. And because the question that I got and our team got coming out of the banking crisis in March was, why do regional banks even exist? Like, aren't they like a big retail mall? Like, they're just going to go away? And I think it's easy to say that until you appreciate the US banking system and the community bank model. Like, as someone who actually worked at a small community bank 20 years ago in Northern Virginia, there is, now we can argue that is Canada better with 6 banks controlling 90% of the market compared to the US? US is a very diverse economy. The customer needs are very different. And I think the community banks actually thrived during that period. Even in the March panic, when you look at the community banks, and these are banks with less than 10 billion in assets, they knew their customers knew their banks. There was no panic. So there was some subset of banks where there was a heightened degree of volatility, which ensued. And as we've seen, when you look at, again, if you look at the cost of deposit for banks today, in a world where the Fed funds rate is 5.5%, deposit cost for a bank on average is about 2.5%. What does that tell you? There's a stickiness of client relationship at these banks, and there's a reason beyond just putting in deposit and what they're getting paid is why customers bank with a certain institution. So that was not the question you asked me, but I think it was important to sort of lay that groundwork of relative to our discussion. And then in terms of crypto, so you're right, I think crypto, it was extremely nascent, and like as someone who had absolutely very little idea in 2018-19, and then it took off around the same time the pandemic struck, you had a bunch of stimulus spend, and this whole evolution of the crypto industry. And I think it did expose, like to me, again, at the core, it exposed the fragility of, and you addressed this in your keynote, the combination between fragility and technology. The fragility comes from what regulators will be focused on over the coming years, and including my conversations with the Treasury, with the Fed, and other policymakers, is what's the fragility of bank deposits, right? How do you measure them? What's the duration of these deposits? And I think with Signature Bank, it's interesting, all throughout 2021, we would debate that actively, is, you know what, you're bringing in all these crypto deposits, can you actually lend this out? Like, does this deposit base have any stickiness to it where you can actually take duration risk, which is kind of what banks tend to do, is take a lot of deposits, they tend to be sticky, and sort of lend that out to their customers. So I think crypto, clearly, I mean, I think Silvergate was a pure play crypto bank, and I think they had a duration mismatch too in terms of it was, I think, 99% crypto funded bank in terms of the deposits. And as soon as the crypto industry faced volatility, took their deposits out, Silvergate ran into trouble. Signature did also get impacted by their exposure to crypto, but the trigger was SVB that happened on Thursday, and then that led to the deposit run at Signature, which was amplified by their exposure to crypto. And I think it was also, what was at play was the regulatory discomfort with banks' interplay with crypto industry, period. And I think that also contributed to the concern that the regulators had with Signature Bank, which had so far been sort of growing significantly in terms of just at the back end taking the fiat dollar deposits for these crypto players, and that contributed. So I think Signature was a function of events that happened that week with SVB, and then I think their exposure to crypto further amplified their demise. But I'll stop at that. Yep.
Thank you very much. So let me move over to you, Werner, and talk about something else, disclosure. And we talked a little bit before the panel. You said that disclosure was not an issue in 2023, that all the information was out there. But in general, when you think about the information that depositors have, investors have, I think it's always a tricky question. And even with 2023, you can argue, well, even though people knew it wasn't so salient, and maybe there were different ways to highlight the information and explain exactly what is going on. I think when we think about disclosure, once you start thinking about it, you realize it's more complicated. Because you don't always want to come out with all the bad news. Sometimes you want to hide it a bit. Sometimes you want to pull things together. You know, if you do stress tests, for example, and you go out and say, this bank is in trouble, we know that the next thing will be that there will be a run on this bank, and then you made the situation much worse. So the question is, how do you deal with it? To what extent was this an important issue in 2008, in 2023? And based on your experience, what are some of the strategies to address the situation?
Yeah, I'll try to go there and also go to the other topics, because I do think we're mixing up a few things. One is transparency to your owners / investors, right? We say investors, but it's really the owners of the company, right? And in theory, when money moves slowly, you know, through the mechanisms of the boards, et cetera, they are supposed to manage the risk of the company, right? They're supposed to help set the strategy, how much you have in the short-term deposits, what risks you're taking as a corporation. And the reason I said that is about Silicon Valley is because everybody knew what they were doing. They were in fact celebrated as somebody who figured out how to attract a specific clientele that pays a premium to them, just, you know, we don't quite know why looking back, but they were willing to do that, right? And so one could argue that that is, in that space, it's not the problem. There are plenty of other problems. 2008 is a good example, where the lack of transparency resulted in sort of assumption that risks were lower than they were, right? Because things were moving faster. Now, as money is moving faster, and I said before, I'm not a banking person, but as money's moving faster, this gets more tricky, right? Because suddenly, from one day to the next, or maybe even over the weekend, you get into risks. You know, if you think short-term liquidity is a problem and people stand in line to get your cash out, wait till everybody can get it out in a microsecond, right? So transparency, you know, don't get me wrong, there's plenty to do in transparency, but for that particular problem, Silicon Valley, because it was transparent on the risks they were taking, and on the other hand, the speed of which future transactions are going to take, it's just not going to solve it, right, in my mind. So which then brings us to some of the other things we talked about, and you know, there's so much, I don't know, there's one thing we talk about then is, sorry, looking at my notes, right, is sort of blockchain. Right? Blockchain is a great tech. This is one application of tech. So we should just sort of say crypto is just one way of using it. It has really nothing to do with its blockchain or whatever comes next. I'm sure somebody comes up with some other thing, right? So that leaves us then with sort of what is the question about something like crypto on this whole thing, and you know, what's the regulation? And I fully understand the desire to innovate the payment system. We can get money in and out faster. I learned that from Dani because I know not much about that other than on the payment side, on the processing side. But to me, it's also not the problem. And you know these numbers better than I. Literally just Googled while we were sitting. Crypto is maybe $200 billion a day traded, give or take, but it's in the sort of triple-digit billions, right? Currency trading is $8 trillion a day, right? Why don't we leave it that way? Well, let's just not regulate this. It's a niche market. You know, the folks that speculate in it should know what risks they're taking. In theory, fully acknowledge the theory, have a mandate by the board and therefore by the shareholders how much risk they can take in that. And we will see failures. And as long as the failures are small, Silicon Valley, yes, in terms of assets was big, but in terms of impact in the end, after a couple of days it was small. Because the Feds got better, right? I mean, they reacted way faster than they did in the past, so congratulations, right? I am not sure that in whatever way I would allow sort of the large banks to play in that field of whatever it is of speculation, because to me, again, I'm not working with banks, but to me, crypto is a speculation, and the reason Dani and I are colleagues, so I can be. The reason banks are trading at a 0.8 market to book is because they systematically destroy value. Okay, that's a return on equity on average, not like obviously there's a big spread, right? Their return on equity is lower than the cost of equity because they're taking risk in the spirit of making a lot of money, and then every couple of years the risk catches up with them. So I'm fine where we are. I don't want to give the ability to, you know, banks that are too big to fail, know that they're being bailed out, to speculate even more. I can't solve the payment problem. I'll leave that to others, right? But you know, in summary, to me, if you connect all this, you know, let's move a little bit slowly on this. There's no urgency. It's a small market on the crypto side. Things will go bankrupt. That happens all the time. Investors and speculators will lose their money. That happens all the time. You know, let's step slowly. Combine it with some sort of transparency, obviously, but to me it's more comforting, or it's really comforting on the regulatory side that the regulators are fast in action and thoughtful in their regulation.
Okay, very good. So let me move on to the next stage of the panel, which is more of an open discussion. So I will react to a couple of things that were said here, and then pose a follow-up question for everyone, for all of you to intervene and give your perspective. So when you think about the regulation of the financial system going forward, and you said something, Werner, at the end that maybe we should not regulate parts of it and sort of let it be concentrate on the banking system, making sure that there aren't excessive risks there. My concern is, and I think we saw that a little bit in 2008 with the shadow banking, that if you regulate one part of the financial system and you leave other parts unregulated, then these parts are starting to grow, and then you don't have enough information about what is going on there. And at some point they become so big and they blow up, and then you have to do something. I think if you think about, again, even the aftermath of 2008, there is increased regulation of the banking system. One thing I looked at was that some of these activities moved to other financial intermediaries, market-based intermediaries, like funds and things like that. And then they are not regulated the same way, but some of the risks are there, and then all of a sudden you see that there is a problem there. So how should we deal with it, and how should regulators think about regulating the financial system going forward? What are some of the lessons we learned from the recent events that can help us think through that? So, and any of your comments here will help.
Well, since you addressed me, I'm just going to say, and again, if a bank or if a corporation of anybody invests in something that is more risky and more, that's when transparency comes into place. From my perspective, right? And I know regulation will move, but so you decide to invest 3% of your assets into something that's very risky, you just have to be transparent about it. Now, maybe we need regulation to be more transparent. I completely give you that, and I'm the first one to say there's plenty to do there for the SEC and others, right? But I'm whenever you regulate something, there's always a loophole somewhere, right? And sort of your argument, you leave some aspects unregulated, it's sort of just, it's just the nature of the beast, right? It moves it down, and not much we can do about it. So, but I do think it's worth thinking about, again, the transparency to your owners and to your shareholders, which would have, not sure it would have avoided 2008, but the biggest problem there was the transparency of the risk in my mind. Personally, again, not a banker, not the markets. It was that investors in the third derivative of some mortgage didn't realize what risks they were taking, and that's a transparency question, not a regulation question in my mind, at least.
I think what I'd say is, it is a complicated question, right? When you talk to the regulators, and the OCC, the Fed, the FDIC, they are responsible for the banking system in terms of their direct mandate. And I think we've debated this. So obviously, a lot of measures that were instituted post the great financial crisis have been for the betterment of the system. The liquidity stress testing, the annual credit CCAR stress testing that the big banks go through, all of that, I think, have given them a better appreciation of their data, what they're dealing with, what are tail risk events that they're dealing with. So I think there have been a lot of positives. I think there's a vibrant discussion both within the banking industry and outside is, are we just pushing the risk outside the system? And it feels okay to say that, a private equity fund has an asset owner somewhere in the Middle East. If they lose money, the asset owner loses. Deposit is not at risk. But I think, to your point, when the non-bank sector, right, to your point, you made the comparison around tech stocks and banks. Look at the 3 largest private equity players versus the 3 largest banks over the last 10 decades. It'll tell you where money capital has gone, what market has rewarded. And I think what you worry about is, if you continue to and there's another proposal out there tied to the Basel rules to further regulate the US banks, and I think the risk that you deal with, at what point do you push enough risk outside where the non-banking sector, be it a hedge fund, where Citadels become one of the biggest market makers on the equities, when do those players become so large and they're unregulated? And the only reason right now it feels okay is because we've not seen an accident happen, right? If you go back, 1998, long-term LTCM, the large hedge fund, it blew up. Non-regulated hedge fund blew up. Policymakers had to step in. So you worry about that, and I think that's where there is a fine balance. I think what I would say is, despite the comments around just the D-rating and valuation for banks, we cover, I talk to my colleagues globally all the time, the US banking sector and the US capital markets is probably the most, it's not perfect, but it's probably one of the best banking systems and capital markets in the world. So can you make them better? Can you make them more resilient? Absolutely. But I think we need to be careful how we proceed and what areas we are regulating or not regulating. And it'll be interesting. I think the one thing, based on coming out of the elections, depending on what the election outcome is, you could see Treasury Secretary Yellen's talked about looking at, within the FSOC authority, looking at non-banks. I'm not sure if it goes anywhere, we might see some movement there.
Danny?
Sure. So, so I agree with you about the fact that a lot of the banks were fine in 2023, and post-crisis, the banking system is a safer system. There's a lot more capital, there's a lot more liquidity, and there's a lot more resiliency to deal with crisis. And the point around the secular trends of lending moving off balance sheet and technology with the fintechs, so both technology or provision of like infrastructure as well as capital is moving off the balance of the banks, is that how does the regulatory oversight keep up with that? The Basel IV proposals are pretty old, and they're getting through. The last week, the comments period was due back by the banks. In the US, they call it the Basel III Endgame, which really brings back a standardized approach to risk measurement. So the Basel III Accords and Basel II had banks, please develop your models and tell me what you think your risks are. And post-crisis, there was a big onus on the banks to say, identify your risk. Risk ID became a really big thing, and based on your risk, create models that evaluate what are the tail risks with that. With Basel IV, we're standardizing calculation of credit risk, market risk, and operational risk, so that the regulators think that they can cross-compare the industry. Now, the risk that that poses is like, these are really slow to come around, years in the making type thing, and we're standardizing our way of capitalizing the banking system basing on the standard lookup tables of what risk weights are based on different asset classes and riskiness of those. So we're taking away the onus from the banks on saying, tell me what your risks are. That is a risk in the system. And I think with so many kind of nascent risks, or the risk may look differently today, tomorrow than they will look today, I think that there is a, to me, there's a big question mark, is like, how do regulators evolve and innovate themselves to be in lockstep with the time? Now, the one thing that the US has done pretty well is getting anything through Congress is a nightmare. It goes through cycles of like the presidential election, nothing is going to get done now but until the next election. It goes like in big cycles like that. So to bypass all of that, the US regulators have created this SR letter, which are the supervisory letters, which are guidances, but the whole banks are up against guidances. And the guidances have proved actually to be a pretty effective tool, because you don't need Congress to approve and put into legislation or go through the whole kind of NPR, the Notice of Proposed Rulemaking, but they can actually send a letter and then do a review, a horizontal review of the banks and hold them up to that standard. And that's pretty, I think that is a great tool that the agencies in the US have done in order to kind of hold up institutions against, and they should continue to do that, and they do continue to do that. And they've been very responsive to when an event happens, they create an SR letter, go look them up, and on counterparty credit risk, on liquidity risk, on leverage lending, on model risk, there's a lot of guidances out there, and banks are being held up to those things. And in the past year, there've been horizontal reviews on liquidity. Everybody got like findings on liquidity to up their liquidity risk oversight. They all got findings on counterparty credit risk. They're all getting findings on like how do you manage market risk. So these are very effective tools that they're using.
Can I ask a question to Danny? For many here in the room, a standardization of an approach sounds like a good thing, because otherwise you sort of rely, I mean, in the minds of many students, I'm sure, on some manager somewhere to say, it's not that much of a risk, right? So can you again formulate, like, what is the argument in the Basel IV regulation? What's your argument against standardizing risk assessment, other than there might be new assets that we don't know yet, which is a fair point, but what's the problem with
It's
that?
not new assets, is new risks. So if we can describe the world neatly, and so that everybody can do apples for apples, this is what the intent is. Let's do apples for apples, and we can all kind of cross-compare based on the same rules. Now, can we describe the world in a neat, uniform distribution and basically say, based on my 2 standard deviation or 3 standard deviation, pick your spot. I'm going to calibrate the capital based on a standard distribution. Now, go and find the banking system that all of it goes across a standard distribution. So it's not about where in the tail you are, it's which distribution you're in. And so it's very much can I create a rule set that tells me exactly what risk I did in every type of loan? There is financial innovation going through the door every day, different financial products, financial structures. And so we say that for the next 10 years, we have this grid and they all fall neatly in there. That creates risks. Because in your quest for simplicity, then what are you missing? What a big risk that you're missing. And if it doesn't fall within that neat grid, you don't get charged capital for it. And it's outside of the thing. And you lose the muscle to say, it's for you to tell me what your risks are and how you're accounting for. Post Dodd-Frank, there's like risk ideas, like tell me what your risks are and how you're mitigating those. And I was like, forget all of that, put them in the nice grid. I think that's a risk.
And if I can just add one thing to it, I think very simplistically, I think there is, when you have a lot of policies and frames and thousands of pages of regulation, I think what sometimes goes missing is common sense, right? And I think, and I think we mentioned earlier, right, with SVB, it was not a disclosure problem. It was a supervisory failure. These regulators are at these banks every single day. So anyone who says, oh, a smaller bank at SVB was not as tightly regulated, no. These regulators are there every day. There is a complacency that sets in. Either they become too cozy with the banks they're supervising, or there's just an oversight on the part of regulators, which they're never going to say this. But I think there's that element of it where the regulatory system, the big teaching out of liquidity stress testing coming out of March is that the on-the-ground regulators need to be a lot more alert and be asking a lot more questions. That did not happen with the 3 entities or the 4 entities that failed.
So one conclusion of the day.
Insights on that point, on the regulation. So I don't disagree with you, but I'm gonna. So I mentioned about the categories. SVB was a below $100 billion, so it was not even a category. So they had the on-site regulation, they had the C team or the D team. And then based on regulation, you cross over, if on average you cross over the 100 billion, over a 4-quarter period, you need to bring up your standards to category 4. And over the next year, we're going to evaluate it. So they were in that process of being evaluated as a category 4 bank. And so they went from the on-site team, which was a below 100 billion bank, to being regulated up to a category 4 bank. The GSIBs, they really get a lot of oversight. They get the horizontal team, which are the specialist team. So they were regulated, but not as much. That's point number 1. Point number 2 is, and this is part of the Fed, and I said before, Economic Growth, Regulatory Relief, and Consumer Protection Act of 2019 by Congress was to basically be a bit easier on the banks. All of your regional banks that you mentioned is stop hammering them down. So there was some inside. So some of these things were findings, but they were asked internally to the regulators to not be as urgent or be as heavy. And so the tide shifted within the regulators. Don't be as tough with your banks. Those are your customers type thing. And those two things, they didn't have the A team, and they were actually, for the things that they've identified, it's ease up a bit. That was what was going on inside of the Fed and the FDIC, unfortunately.
Right.
So I think part of the problem is that regulators have a hard time keeping up with the developments in the financial system. In many ways, what they're trying to do is they're always looking back and trying to solve the problem that most recently appeared. But the financial system is constantly evolving, and to be fair, there is also a lot more talent that is going into the financial system than into the regulatory system. So the question is that even a battle that they can win? What can we do better to really sort of foresee the risks that are coming in the future and not just look at what happened in the past?
By the way, nobody talks about CRE, commercial real estate. So we all say that we knew about the risk. We know about the risk in commercial real estate now, and it hasn't realized. There's going to be a lot of destruction in value in commercial real estate over the next few years. And there's a lot of loans out to, there's a lot of CRE loans into the balance sheet of banks. So there may be an event on commercial real estate. Work from home, dislocation outside of Earth, there's some big secular trend, and there's a lot of assets in the banking system of commercial real estate. So that would be a good example of that. What are we doing about that? So there is a lot of talk about it, but I think I think the use case, for example, is going to be around CRE, I think.
I think the one thing that which we've not talked about the Fed at all, I think, given just the current crisis, I think it's also worth keeping in mind, and this is not to absolve regulators or bank management teams of risk management missteps. All of this happened on the back of an unprecedented hike in the Federal Reserve interest rate cycle. We went from 0 to 5% in 12 months. This was, within a month, the Fed went from quantitative easing, when they were injecting billions, to all of a sudden waking up that they need to hike 25 or 75 basis points. So if you can go back, I would encourage all of you to go back and look at history of Fed funds rate. Nothing like this has happened for decades. So when you think about a lot of these bank management teams, they take their cue from what's the Fed governor telling us about the outlook for interest rates. And the outlook for interest rates, as I said, till Jan 2022, 3 months before the Fed started hiking, was we were quantitative easing. So the reversal, the policy reversal there did catch absolutely. So you mentioned earlier the duration risk. I think, again, not to absolve the management team at SVB from risk management, but you are in this notion of inflation is transitory. That's what the Fed is telling me. I do have a lot of liquidity. I don't want to take on credit risk, so I'm not going to make CRE loans. I'm just going to buy government bonds. And how do you lose on that trade? We know how you lose on that trade now. But so I think that's the other thing for each of you to keep in mind is what happened here was an unprecedented Fed hike cycle. We went from quantitative easing to tightening, and maybe now we are probably at the end of that cycle, and maybe we go the other way. So I think I think there needs to be some self-reflection within policymakers of what happened, because the Fed manages monetary policy, but they do regulate the banking sector. Should they have seen the consequences of when I go from 0 to 5%, what happens? And I think to the point you mentioned on commercial real estate, the same thing, right? The rates have gone up so far. Now, I will say this, if you go back 3 years, 4 years, 5 years, the Fed has been providing guidance, the OCC in particular, around commercial real estate risks. But there are some secular trends, right? Like, I'll say this, for the last 10 years, retail CRE has been a loss maker. You have empty malls all over, you drive around. Now, did a lot of banks go out of business because retail CRE or more? No. Office CRE is the same thing. Now, maybe there'll be smaller banks that go out of business. But yeah, a lot of that is in the CMBS securitized market. And banks will take their chunk of losses on pockets of CRE office. Longer term, though, I think whether or not commercial real estate becomes a bigger deal or not comes down to two things. What happens to the economy? Do we still have job growth in the US 6 months, 12 months from now? And second, is the fight against inflation won or not, right? Are we in the 70s where the Fed's going to have to, again, reverse course hike again? Or are we at a path as the forward curve, as the Fed dot plot assumes today, that we'll get maybe 3 or 4 cuts over the next year?
Yeah, I'm going to try to close 2 circles. Not sure whether I'll succeed. One is what you just said, is this fast rate hike. Isn't that to me, that was actually a good thing, right? Because they reacted fast. Best I can tell, the economy is doing fine, despite everything that everybody, or many people believed, right? Now, did they overshoot? Probably. I don't know. I'm not a macroeconomist. I have no idea. But the alternative of reacting slow, like what happened in the late 70s, early 80s, seems worse. So I don't know the answer to that, but this probably has 2 sides to that particular one. The other one, you ask what can be done, and I liked what you said earlier, Ebrahim, that it's sort of, you need to get back to common sense, right? So in a previous life, I was a paramedic back when I was in Germany instead of military service, and one of the things that we learned is that you can't plan for all catastrophes, you have to learn how to manage them. which has to do with quickly setting up a central management team, having the experts, et cetera, like what happened over that weekend apparently in Silicon Valley Bank, right? And I'm hoping that well, it looks to me based on 2008, a lot of people learned a lot, and that we have these things implemented. I don't know, I'm not an insider, so I think if you guys take one thing away from this panel, it's that common sense is not that common. And there should be more of it in, probably with regulators mostly, but also, quite frankly, with banks and companies.
Okay, thank you. So I think we are out of time, although we did start a bit late. But I do want to see if there are questions from the audience before we close the panel. Yes.
I am Alvin from Cornell, and I have a question for Dani. So you talked a lot about, I think the quote I enjoyed the most is, "It's not cool to be a bank anymore." So I want to hear your opinion on what do you think of the digital banks that are emerging nowadays?
Well, whether it's cool to be so the digital banks, Chime, Varo, Revolut, have been making a lot of noise. In terms of, I love the digital banks because they're showing innovation where banks have shown, where banks may have shown complacency. I think is the impetus to innovate. Something that we haven't talked about now is, there's an argument to say banks are in the business of technology. They're technology companies. And as such, you want to innovate all the time. JP Morgan gets that. JP Morgan is probably one of the largest technology companies in the world in terms of how much R&D they spend in technology. The digital banks are creating innovation from a user experience perspective that we can see and touch in our phones, and a lot of the banks don't have that. Now, as business models, they're being valued when there have been some transactions of investments and round of investments, somewhere between technology companies and social media companies, on terms of the expectation of future growth. So EV, enterprise value, to me is all about the expectation of where you will go. But all of those business models have really struggled to attract sticky deposits and to actually start making the business of money, which we talked about maturity transformation. They're in the business of lending and gathering deposits. I don't think they've done that very, very successfully. There's very few examples of not from a valuation perspective, from what do they do and how solid their revenue stream are. So I think they're great at innovating, and when I say great at innovating is slashing cost to income ratios, slashing the cost to originate a customer, really reinventing what it is. Now, bigger banks are paying attention. JP Morgan has created a digital bank in the UK. There's been acquisitions and stuff like that. So I think from a technology way forward, great. From a business model, I think is really to be determined if those are viable business models. And getting a license as a banking license and OCC and FDIC data has proven to be incredibly difficult in the US. With a lot of issues, and I can't remember if it was Varo or one or the other that got their charter last year as one of the first national charter versus state chartered. And the UK has really showed us the way forward because of the PRA has been a lot more engaging in dealing with banks and helping them through the process versus the US ones.
So I think there was a question there.
Our staff will be giving out the mic.
You're doing this.
Thank you.
I come from China, and if we look back into the Chinese stock market, we can see the leading industry and companies changing dramatically and that's rapidly every 5 or 10 years. And I think it's about 5 years. So my question is, actually there are 3 questions. So the first question is, do you have any predictions for the leading industry or companies in the next period, maybe 5 or 10 years? And the second one is, honestly, did you make any failed or let's say wrong predictions in the past several years. And for me, I think in like 2 or 3 years ago, we think metaverse or like 5G will be leading the next period of business, but actually we see, at least from my personal opinion, I think it's not that good. And the third one is, do you have any successful practice method or principles in predictions, especially in making successful predictions? Thank you.
I think if we had, we wouldn't be sitting here, but rather on our yacht somewhere. I don't know how to, I don't know. I'm going to leave it to you guys to think. You probably. But so one thing, when you look at what drove the market in 2023, and invite you to all read the blog posts we put on that, it's basically 7 companies that drove the S&P 500. So you look at those 7 companies, and you do have to scratch your head about how long can that continue, right? So that's sort of point 1. It's not the broader market. If you look at the median multiples, they're actually not that much higher than before, whatever, right? So, and then from that, you can probably have certain conclusions about some of the industries that you mentioned, and, not a surprise that a lot of the 7 are in tech, right? So you do wonder, how long is that going to continue? Is it going to be in cycles? The other thing I'm going to say, whenever I lost money in the market, it was because of banks. So I do, now I'm wondering about the commercial real estate thing that you mentioned, right? It's not that I can invest in individual companies because we're just not allowed to. I'm sitting in these index funds, and I'm wondering when the next thing comes. So I'm the wrong one to answer that. But the one thing I would encourage everybody as you, for your personal or as you analyze things, always look at always dig one level deeper than just an index number or a market number. And again, last year was kind of really strange because you have these massive returns that were driven by even more massive returns of the NVIDIAs and others of this world. And that, NVIDIA is not going to triple their market cap next year. Well, maybe they will, but it's unlikely. Let me put it that way. It would be somewhere out on that curve that Dani drew earlier.
So, a few things, right? So I think one, like to me, for the last 20 years, and this is held up, is more of global GDP is being dominated by technology and healthcare, right? We talked about SVB as failing. There's a reason SVB was celebrated was it was indexed to the right part of global GDP, globally, and they used to do an amazing job catering to their client base. So when you think about healthcare, aging population in the Western world, in terms of innovation, be it India, China, United States, I think none of those trends are changing, right? Like NVIDIA could be valued differently, but will it be AI or something else, or things will move, right? When you think about technologies, even in the last 10, 15 years, that have changed our lives, Netflix, Uber, etc., that's going to continue. So I think indexation to that part of the global economy is probably going to be a rewarding period. I think in terms of, have you made wrong predictions? Well, I can't even count how many wrong predictions. The beauty of my job is everything that we predict is out there, so you can very quickly be held accountable for being right or wrong. What I will say is, I think especially in the last year or two, I came across my Twitter feed yesterday a quote from a year ago where some of the prominent CEOs, investors in bond funds were like, a recession is coming. Jeff Bezos said a recession is coming, businesses should hunker down. This was 18 months ago. Jamie Dimon said there's a cloud storm coming, right? And these are all respected, really intelligent people. I think the ability and the willingness to look past the narrative is important. So when you're thinking about how do I make decisions, there's a lot of narrative flow where it feels like, okay, this is what everyone's saying, this must be the next cool thing. Do your work. And as someone, as an immigrant from India who's been here, I've been here for I remember coming out of the great financial crisis, and all you heard was China and India are going to take over, like US, we are in this quagmire, like GFC, like we're never going to return. Look at the 10-year returns of S&P versus any other index, right? So I think, look past the narrative. I think there's a lot of bias towards the narrative taking over, and I'm not sure what the narrative of the day today is. Clearly it's banks are not cool, but so I think that always helps you, is kind of looking against the grain. Sometimes the narrative is right, but many times it's not, and maybe that's where you create outsized returns.
The more buzzwords, the more wrong, probably. Right. Also, don't invest in coal mines, I guess, is a fair thing we can say. So,
I never had any predictions wrong.
Okay.
So one prediction I have by looking at this room is that we're heading towards a corporate world with more gender balance. So that's really cool.
So I think we should close the panel. I will say just one thing in conclusion. I think making predictions in economics is particularly tough. So I think we have other panels today on healthcare, sustainability, and technology. Maybe they can have more success in making predictions. But with that, let me close the panel. I think it has been a terrific conversation. So let me thank my fellow panelists here and look forward to talking to you more throughout the day. Thank you.
Thank you.